Yeah. Good morning, colleagues, countrymen. Lend me your ear. My name is Alex Kumalo. I'm with the Minerals Council, and I look after social performance. And in as far as today is concerned, I also work with Grant on the junior and emerging and exploration mining segment of the Minerals Council. First and foremost, I'd like to thank you for joining us for this webinar. We've been looking forward to hosting it. It really is important for us that we have this webinar because we, as some of you might recall, we did some research into the junior mining space in 2019. And 6-7 years later, a lot has changed. So it was important for us to get a better understanding of what is happening out there so that when we continue doing what we do as the Minerals Council, that's advocacy, we are using up-to-date information and knowledge. It will be a fairly short webinar. We are scheduled to be together for 3 hours, but that time will go by very quickly because the topics for today are quite juicy. They're very exciting, especially for those of us that are in the space. But today is not about it's not about me. We will have 3 presentations. And the first one will be from Bongani Motsa, who is our acting chief economist, who's going to give us the lay of the land when it comes to mining in general. And then we will then have the report, a presentation on that by Dr. Manikri. And then we'll end off with Francois, who's going to look into some of the funding options that are out there. We'll know that funding junior mining exploration is a very tough one. It's not as easy as getting a loan for a bricks and mortar business. This is about mining, which is a space that requires a long lead time. You might get a very long runway after that, but sometimes you've got a very short runway. So it is a fairly risky space. To kick off, then I'm going to ask Debelo Chabana, who is the senior executive responsible for public affairs and transformation and communications, to give us a sense of who this animal is, the Minerals Council. Debelo?
Thanks, Alex. So I guess our theme for today is, are South African junior miners thriving or not? And as he said, we're looking at some current research studies into opportunities, challenges, and financing options. So, despite the fact that the junior mining sector has shown some growth over the past decade, it faces many challenges, particularly of regulatory compliance and access to finance. Global junior mining is associated with specialist exploration companies that are typically funded by venture capital and explore for new deposits. Once the minerals have been discovered, they on-sell developments development rights to producers. South African junior mining companies are typically small and to medium producers in most commodities. Those that are exploring are usually in brownfield projects, and due to the dearth of venture capital in South Africa, often rely on revenue generated from production to fund exploration. Others seek funding from international markets, particularly from Australia and Canada. This is often supported by funding from internal markets, such as the JSE once they list, as well as state institutions such as the IDC. So the Minerals Council is an industry advocacy organization dedicated to supporting the interests, advancements, and growth of the South African mining sector. The Minerals Council provides strategic guidance and advisory services to its members and fosters their collective interests. It serves as a primary or principal advocate to government, relaying key policy perspectives endorsed by its members. The Minerals Council represents mining companies producing about 90% of South Africa's mineral production by value. The Junior and Emerging Miners Desk, as you mentioned, as you've been told, is really the primary advocate for junior mining in South Africa, and it conducts this research into the sector on an ongoing basis. This is to understand the sector better, to be able to support the junior and exploration sectors better. So this webinar talks specifically to some current research initiatives. Another study into the sector has been conducted, which is an update of the one that was done in 2019. This will form the core part of the webinar and will be supported by current economic overview of the mining industry, as well as another research project that we have that examines funding options for junior mining companies at different stages of the mining project cycle, as has been alluded to. All the presentations are evidence-based, and we hope that you find them useful. Thank you, Alex.
Thanks, Debelo. As per culture within mining, our next agenda item is a brief safety and health share. We do this because we prioritize safety in the mining industry. But my share isn't a positive one, but it is one that we are all learning from as we go along. Colleagues, you would have been aware of the fact that sometime in February, there was an accident at Ekapa mine in Kimberley, where we eventually lost 5 of our colleagues. Their remains have been recovered, and it is always something that we have to talk about, as difficult as it is, the importance of safety in the areas where we work. As mining industry, we are committed to zero harm, but it takes a village to raise a child. And to achieve this, it will take each and every one of us involved in mining to do our bit to get to where we want to get. And that is making sure that every evening, each and every one of us involved in mining returns home safely to be with family. Our thoughts are with the families and the colleagues of those that worked at ECAPA at this very, very difficult time. The mining industry will continue striving for that. And our safety department works very hard with our members to share lessons learned from minor incidents and to major incidents. So as I close off, I just want to again highlight that, as Minerals Council and our members in totality, we are with those families in those each and every day. Thank you. I'm going to then move on to another share that we have on our agendas as Minerals Council, and that is our diversity, equity, and inclusion share. And for that, I'm going to ask Alan Secom, who's our head of communications in the Minerals Council, to lead us for that item. Alan?
Thanks, Alex. Good morning, everyone, and thank you for joining us today. I'd just like to point out in the chat group, I've put a link to our International Women in Mining Day event. At that event, we recognized 10 remarkable women in mining. And this year, it was women in education who we were particularly honoring. If you go into the website, you will see the 10 education and development heroes. These colleagues of ours were nominated by their peers and recognized for excellence in their field and their contribution to mining. This is the 6th such initiative or iteration of Women in Mining Heroes that we've launched. And it ostensibly marks out women who have done remarkable work in an industry that is historically male-dominated. Thank you. I'll leave it there.
Thanks, Alan. Colleagues, then I'm going to now hand over to Grant Mitchell, who's going to briefly tell us about the Junior and Emerging Miners Desk. A name actually that we need to change, Grant, considering the portfolio has grown to include specifically exploration. Grant, over to you.
Okay, thanks, Alex. Morning, colleagues. As indicated, I'm responsible for the Junior Mining Desk in the Minerals Council. We started this project, I think, about just over 12 years ago with less than 10 members and very little support structures within the Minerals Council. Historically, the Minerals Council supported the big companies. But over the past 12 years, we've grown to 35 members, which means that we represent more than 50% of all members of the Minerals Council. So the Minerals Council today, the current Minerals Council, represents both big and small companies and the exploration sector. The work that we do on the desk, there's a link which you can have a look. After the meeting, you can familiarize yourself with the work that we do. Obviously, we're very research-driven, as this webinar indicates. We also run webinars. We engage extensively with stakeholders, the regulator, Council for Geoscience, JSE, etc. And we also have a leadership forum called the Junior Exploration and Mining Leadership Forum. That's made up of the CEOs or a sample of the CEOs of the junior companies. It meets 4 times a year, and that provides leadership for our project. And in a sense, the desk is the implementer. So in a nutshell, that's really what we do. I'm personally very excited by this project because, as has been said before, we are research-driven, and we're research-driven because we need to try and understand the sector. We understand the sector, then we can provide support. I've worked with Dr. Mani Creel right from the beginning, his first report, and when we come, we can introduce him further. But the first study that we did was in 2019. And I think that really was the first empirical study into the junior sector in South Africa. And since then, we've grown and we've developed it. So thank you, and looking forward to the webinar.
Thanks, Grant. Colleagues, you will be aware that the session is being recorded. We hope that that is okay. It will allow us to also have the webinar posted so that people who are unable to attend today can access it. In terms of Q&As, please put your questions onto the chat box so that we can manage them and also respond to them in a sort of decent and fair manner. And on that note, I would like us then to kick off with the program. And I'm going to ask Bongani to then take the podium. And Bongani is really going to give us a broad overview of the status of the mining industry. But before I go to you, Bongani, I see that Mzila has joined us. Mzila is the Chief Executive Officer of the Minerals Council. Mzila, over to you.
Hi, Alex, and good morning to everyone. I just thought perhaps I can just say a few words ahead of the formal start, if you don't mind.
Please go ahead. Colleagues, Mzila is traveling, and hopefully, Mzila, you're not driving.
No, I'm not.
Over to you.
Okay, no, I'm not driving. I think as you properly started, safety first. And so I am sitting in the back seat. I will be off camera as I give this brief outline. And really what I wanted to share is that, we are at a critical time, and there's two perspectives I wanted to share as an illustration of the criticality of this time that we find ourselves. And the first one is globally speaking, and we have been talking about this for a while now in terms of the global energy transition and the demand for what we are calling energy metals, of which Africa and South Africa are well endowed with. And the second point from a global perspective is the geopolitics. And the best characterization I had of this was that at times it feels like it's too many kids in the playground with insufficient toys. If you look at the scramble for natural resources, both mineral and energy resources. And this is setting us a very significant backdrop for the mining industry, and particularly for exploration. The second perspective is one from an Africa, a SADC region, and a country perspective, as well as mining, in that from an Africa perspective, there's a significant need for infrastructure development, economic growth, investment, and social prosperity. Whilst Africa lies on significantly untapped minerals, resources, and endowment that can provide both the regional and global needs and demands, as I've outlined above. And I think herein is the significance and importance of exploration, which is going to be critical to the confidence in the supply chains for both current and long-term needs for minerals. But to be able to achieve this, I think there are two essential components that we will need to be very aware of, and then this webinar is going to be a conversation on these aspects. The first one, I think a coordinated policy environment, as the Minerals Council has often advocated for. And here from a South African perspective, I'm referring to both within the Minerals and Petroleum Resources Department, but also an equally important across government department. And it's a coordinated policy that needs to intend for a responsible and vigorous investment and development of our mineral resources. The second critical element for me is that we will need to re-educate and reinstill confidence in exploration, particularly when it comes to greenfields development. We're all aware that the current mines in South Africa certainly were founded more than 30 to 50 years ago, in as far as mines being developed from greenfields operations. And so my hypothesis is that currently we don't have an exploration DNA as a country. And I think this is where the research comes in and is important to inform us of the latest developments. And herein, I believe that we will need to educate and create what I call is an ecosystem for the exploration boom that will be required to meet future mineral demands. And so I think lastly, what I'd like to say is that I think looking ahead, we'll need a systemic change that will not only happen merely from regulatory changes or a sequence of events, but rather a multiplicity of changes which will need to happen simultaneously. And so I hope that you have a fruitful discussion. I think the topics that have been laid out are relevant, and the outcome of this webinar should certainly be one that is directed at action rather than more talk. Thanks, Alex, and wish you a good session ahead. Cheers.
Zilla, thanks for those words. I'm sure that what you have just said will be echoed throughout the webinar, and we encourage participants to engage with the material that is going to be presented, and obviously the future of this sector, not just the junior sector but the mining sector as a whole. Thanks, Zilla. Bongani, over to you.
Thanks, Alex, and good morning, colleagues in the boardroom as well as those online. Alex, can I just confirm, can you see my presentation?
Yes, Bongani, we can see your presentation. Please go ahead.
Okay, sure. So I decided to that the topic of my presentation would be basically the state of mining, unlocking the sector's potential. And I think this is very important, especially, I'm not going to talk about the entire value chain. You'll notice that I'll focus specifically on one important aspect of the value chain. How do I move this? So first things first. So I decided that I must place mining basically where it belongs. Mining belongs to an ecosystem, and this ecosystem is both global as well as domestic. So it is important to acknowledge that. Otherwise, you find yourself talking about a sector or sector's challenges or even its success without acknowledging that actually that sector is part of a broader ecosystem. So here in this chart on this slide here, I decided that to provide the domestic.
Sorry, Bongani.
Yeah.
Your slides are not moving on our side.
That's what I was fearing. Just go back, Alex. Okay, let me do this.
Bongani, I can drive it from my side if you want. So just keep the slides on there. I'll just drive them on my side. And just let me know what slide you are on. Okay.
Can you see?
You still need to go into presentation mode. We can see your
Sure. Okay.
Okay, there you go.
How's it now?
I think now you've got full control of these slides.
Okay. So yeah, I've spoken about the ecosystem that mining is. We must place mining where it belongs. The global context is important, as well as the domestic context. So this next slide here. Okay, yeah. So if we compare mining's performance to the other 9 economic sectors, and here we're using the production approach to GDP, and we have to ask the question: how has mining fared? And to assess that performance, we have to then look at the performance of the other nine economic sectors, and we use gross value added, both in terms of nominal, which includes prices or the inflation effect, as well as real data, which is basically a proxy for volumes. So in nominal terms, and we're going to start by focusing on that column there, 1994 versus 2025. In nominal terms, the mining sector was the second fastest growing sector, as you can see. The fastest one was the utilities sector, which is electricity, mainly electricity and water. And then the mining sector was the third fastest growing sector. And then, no, in fact, the financial sector was the third growing fastest sector since 1994. So then let's look at that column there, still under the broader column of 1994 versus 2025. Let's look at the column labeled real. What about real in real terms? So in real terms, the fastest growing sector was finance. It was followed by the transport sector, and mining is the only sector, as you can see there, is the only sector that contracted in terms of volumes. So in 2025, the mining sector was 11% smaller than what it was in 1994. The utility sector had only grown by a mere 8%. But important to note, the mining sector, if you compare it to how big it was in 1994 and 2025, it is the only sector that contracted in real terms. So, but we then said, look, 1994 to 2025 is too long to a series to look at that entire period. So let's shorten the analysis by looking at 2010 to 2025. And here 2010 was chosen because that's the first year post the global financial crisis, which brought a global recession to the basically to the global economy. So typically, I think this needs to be stated that typically, you know, for sectors with serious structural challenges, when there is an economic recession, it is very difficult for those sectors that have embedded structural challenges to recover. So that's why we picked and said, okay, 2010 to 2015, how have all these sectors performed vis-a-vis as well as mining? So this is now we are focusing on that right column there, 2010 versus 2025. In nominal terms, the mining sector was the sixth fastest growing sector, about 149, and this 149% basically is in line with the total economy. If you look at the bottom row there, that the South African economy, if you compare to to its performance 2010 and 2025, it grew by some 150%. So, but also let's remember that post the global financial crisis, the South African economy grew at a rate of 1.3% per year. It is really what we characterize as uninspiring growth. What about in real terms? Still focusing on that rightmost column, 2010 versus 2025. In real terms, mining shrunk by 7%. And the highlight here in this period, 2010 versus 2025, is that 4 sectors, including mining, shrunk. And it is not surprising again, because that's the period where we actually grew the least. We're growing at an average of 1.3% per year, compared to 3.3% from 1994 to 2009. So that context is very important, and it is very important because here, let me then present this by means of a trend analysis. Look at this chart here. This is a trend analysis from 2010, and these are the sectors whose growth rates averaged below that of the total economy. The total economy is that line represented in blue. So this chart really emphasizes the message in the slides that I've presented before, that indeed, in fact, also the highlight here is the construction sector. The construction sector's performance has really been disappointing. I must say that it is, I mean, I think a phrase for it or a word for it is that the construction sector is really in ICU. And that started in 2016. Who's responsible in an economy for these mega construction projects, which basically lower the cost of doing business? It is government. And government has not been doing enough in investing in construction. But also this relates to repairing existing infrastructure and maintaining maintenance of that infrastructure. So let's move on then to look at the growth rates or lack of it in the mining sector. So this chart here, as you can see, in fact, the title of this slide rightly captures the performance of the sector. It's short summers and long winters. So indeed, if you look at the number of consecutive years where the sector shrunk, there are many of those in this chart compared to the consecutive number of years with green bars. So we have to ask the question, is this phenomenon typical? I would personally argue that it's not. And I'm saying, is it typical in other jurisdictions that are major mining jurisdictions? Is this typical where you have short summers and long winters? Not necessarily. It is true that commodity markets are volatile, but the sector should respond to price increases. And that's what I show in this next chart here. And look at the heading there. Basically, every normal industrial sector should respond to prices, especially here, to price increases. So in this chart, I'm showing global minerals and metal prices in real terms. And it's presented as an index, and it's plotted against the domestic mining sector's real gross value added. And the rationale for doing this is the fact that we are price takers as a sector, and therefore we should respond to international price changes. And international price changes are represented by that blue line there. Two points are clear from this chart. The first one is that the mining sector in South Africa is not responding to higher prices. The second point is that this is not normal. This is not normal unless there are serious bottlenecks, serious challenges holding that sector, that particular sector, and in our context, mining, unless there are serious bottlenecks holding the mining sector from achieving its potential. So we have to naturally then ask the question, why? Why is this happening? Why this phenomenon? But we'll deal with that question later. For now, let's talk about what I consider the most important aspect of the mining value chain. And this is essentially exploration. So what we did is to, like they say, they say without exploration, there won't be new mines. It sounds cliche, but this is ever true in South Africa. So here, what we wanted to do, wanted to see if there exists a relationship between mineral exploration expenditure in South Africa and global exploration trends. And as you can see, the correlation is quite strong between 2000 and 2019. It's a correlation of about 83%. Although I must say that our domestic expenditure, exploration expenditure, is really from a very low base. The second thing to note is that, as you can see in this chart, when we add the post-COVID years, the correlation weakens. There's clear divergence between domestic exploration expenditure and global exploration expenditure post-COVID. So it seems to me that this is due to policy and regulatory uncertainty. And we're going to talk about that towards the end. Sometimes I know some stakeholders think that as the Minerals Council, we always harp on these regulatory uncertainty issues for no reason. But you'll see there's proper evidence why we always talk about that. But also, I think one of the other issues is infrastructure, as well as how investors perceive South Africa, the risk in the mining attached to the mining sector in South Africa. So like I'm saying, you'll see below when I talk about investor perceptions, that investor perceptions do matter. So in short, global capital post-COVID chased resource opportunities in jurisdictions which were investor friendly. So moving on to now talk about the commodity. Did I jump a slide? Sorry, I think. Oh yeah, okay, yeah. I've spoken about this slide. Yeah, okay. Yeah, so let's now talk about a very important aspect here. You know, like they say, if you can't measure it, then you cannot manage it. I can extend that expression to say it is very difficult to come up with policy, either policy to regulate or policy to incentivize a sector or industry if you can't measure it, if we do not have the data. So in our context, you see, while we have aggregate mineral exploration data, that is very useful. But the real value is understanding the commodity-specific exploration dynamics. So this raises the question of which data then can we use, since we know that the data that is mostly available is aggregated data, is sector data. Which data can we use to sort of understand the exploration expenditure dynamics in the various commodities or various industries in mining? So in this country, you know, the reputable sources of data are the Statistics South Africa. We also have the Reserve Bank. We also have Quantec, who are basically a data. They add value to the data that's published by these, especially these two organizations. But there is no commodity-specific exploration data. So to understand the commodity-specific dynamics as it relates to exploration, I thought, you know, it's better to use a proxy. You know, as economics, and also I do think that in other disciplines, in the absence of that specific data, you can use proxies. And in our case, we also use proxies with a gross operating surplus, which we use as a proxy for profits or returns on capital as a factor of production. So in this case, as a proxy for commodity-specific exploration, I thought to use the gross fixed capital formation data. And in there's a line which speaks to research, mineral exploration, as well as the biological resources. That's the blue graph, as you can see on the chart there. So this category, I must say, it also includes exploration in oil and gas. But also, as you can see, it includes biological resources. And these biological resources essentially talks to forestry, as well as breeding programs for fisheries, as well as livestock. So such data would typically then overstate commodity-specific exploration. But in this context, I think it is still safe to use this data, because if there is any overstating of the data, is as it relates to oil and gas exploration, not biological resources. And so, as you can see from the chart, the blue graph tends to trend higher than the other two, which are actual data, actual mineral exploration data. Our view is that the reason why it trends higher than the real actual data, mineral exploration data, the reason it trends higher is because post the global financial crisis, remember during the global financial crisis, oil prices or fuel prices were relatively high. And we know that high prices then motivates industry players to explore more. So we know, for example, that PetroSA, Sasol, Shell, and Total Energies have been exploring more in terms of gas and oil. So with that, let us now look at the commodity-specific exploration dynamics. We start with gold. So gold exploration, especially if you look at the 2025 right up to 2012, it was volatile in that period, during that period. And then you see a precipitous decline in gold exploration expenditure, especially since from 2012. And this really is a reflection of deep geological maturity in the context of South Africa and high cost of production, as well as regulatory uncertainty. Also, we must include this fact here that investor flight. Investors decided that they would rather use their capital in attractive jurisdictions and commodities. But look at that heptagon there at the bottom. Basically, there, what that number represents, it represents the fact that gold accounted for a mere 2.5% of total domestic exploration expenditure. We move on to the PGMs. The PGM exploration has been high and steady. And as you can see, it also the PGMs accounted for about 31% of domestic exploration expenditure. That was the equivalent of about approximately 1.2 billion in 2024. When all the data is updated, we'll have a 2025 number. Let's talk to coal. Coal exploration, we say that it's been formidable. And the reason it's been formidable is because we remember that the coal industry supplies Eskom with coal, and Eskom uses that to generate electricity. But also look at the heptagon there. The coal industry accounted for the biggest share of exploration expenditure, more than 36% of domestic exploration expenditure, which was the equivalent of 1.4 billion in 2025. Even then, there was, or let me say, there still is very little activity in the form of new mines that are established. Move on to chrome. The next three commodities. It's interesting that the next three commodities, chrome, manganese, and iron ore, were the fastest growing in terms of production and size in the mining sector. However, if you look at the fact that from 2021, exploration expenditure in the chrome industry has dipped. And chrome itself, it accounted for 3.2% of total domestic exploration expenditure. But also, let me just take the opportunity to explain that trend line there. I decided to use a sixth order polynomial trend line, meaning that, if you use a sixth order polynomial trend line, you have these bend and twist that it captures more of that. In fact, in econometrics, you say it captures the noise, but it's a very good fit, that trend line. Yeah, it's a very good fit, but even though it's a very good fit, it then tends to capture even irrelevant information, such that it becomes very difficult to use it to project in this context what exploration will be in the next 5 years or so. But just before I leave this slide, that number there, 3.2%, that is how much the chrome industry accounted for in terms of domestic exploration expenditure. If you remember, gold was 2.5%. So exploration in the chrome industry is even much higher than exploration expenditure in the chrome industry is even higher than in the gold industry. Iron ore, it's interesting here that we see a decline in exploration expenditure. This is manganese, and yet again, this is the fastest growing commodity in terms of production in the mining sector. Of course, albeit from a very low base, because I think manganese accounts for about 5.7% of total mining production. But in terms of its contribution to domestic exploration expenditure, that's about 0.4%. Also, this is nominal data. It's not real data. It's nominal data, what they actually spent in 2024. The number in 2024, the manganese industry spent about 16 million in exploration. Iron ore, this is the last commodity. Again, this is interesting because the iron ore industry is the third fastest growing industry, again, in terms of production. And yet, exploration began to take a dive from 2012. If you look at the 2012 number, the industry spent about 614 million rands. And in 2014, it was 243 million rands, accounting for 6.4% of total, for roughly 6.4% of total domestic exploration expenditure. Again, much higher than what we saw for the gold industry. So having presented especially these slides on exploration per commodity, we have to ask the question, what's the point? What's the point of all of this? Why are we presenting this information? Well, this is the point. So we presented the information on exploration, a commodity-specific exploration expenditure. The reason is because it clearly, there is no greenfield exploration. So all the exploration that you see is basically to extend the life of mine. And this chart really represents that. If you look, basically it's indexed to 2004 production levels, and most of the, if not all the industries here by 2020, I think this goes up to 2025, the production in all of these commodities was lower than it was in 2004. So this it's reason enough to believe that, not even to believe, to substantiate the fact that the exploration that's taking place is for brownfields. It's brownfields exploration. Otherwise, you if it was greenfields, the industries here or the commodities represented here would be growing. So let's move on. Here, I'm just showing again, it's a point that I've already alluded to, that the fastest growing commodities are manganese, chromium, iron ore. The point here is that the performance and sometimes the declining size of the various industries is partly indicative of very little activity in terms of greenfield exploration. So we then have to really ask the question, can we measure, let alone estimate, the exploration funding gap? Of course, there is a gap, but we have to start here by showing that, by saying that for some time as a country, we have said that South Africa should account for 5% of global exploration expenditure. And that's the black solid line in this chart, on this chart here. So the period in this chart, it covers 2010 to 2024. And the reason for that, again, is because 2010 was the first year post the global financial crisis. And also in 2009, South Africa did account for more than 5% or more of global exploration expenditure. Actually, we actually accounted for 5.3% in that year. So, I mean, just makes sense that then let's start our analysis from 2010. So what is clear here is that the gap between the 5% global exploration expenditure target and the actual spend in exploration in this country has widened. It was 2.5 billion in 2010, basically 4.2 billion less 1.7 billion. That gives you that gap. In 2019, the gap was about 4.8 billion. It's not reflected on this chart, but it's calculation that I made. But what is reflected here is the 2024 funding gap. And that gap, of course, shown by that those vertical dotted lines. So in 2024, the funding gap was 10.1 billion. The 5% target would have meant that exploration expenditure should have been the equivalent of 11.5 billion rands. But what we actually spent was 1.4 billion. So cumulatively, if you just take the gaps from the funding gap or financing gap from 2010 right up to 2024, the cumulative amount is 80.9 billion rands. And this represented 18.3% of the mining sector's nominal gross value added in 2024, 18.3%. So then we have to ask the question, how do we bridge this gap? That's a pertinent question. How do we bridge this gap? So here, in this slide here, I'm basically showing in this table the organizations that have provided exploration funding or pledged, among other things. So from the IDC's 400 million rands to Anglo 600 million to the PIC's almost 1.4 billion rands. And then you have BHP stroke Orion, I think promising about 10 million rands, etc. So we then said, okay, if you just add all these amounts, we get to 2.41 billion rands, which makes the financing gap. This is the financing gap, assuming that we still to reach that 5% global exploration expenditure share, assuming that it's still 11.5 billion. So what it means is that then the financing gap is about 7.7 billion. So, but you know, the question really is then, does it even make sense to add these numbers that are presented in this table? I'll tell you why. Why I'm asking this question? You see, the funding that's presented on this table is not an annual flow, but it's basically stock numbers. This means that it is not funding that is provided on an annual basis, but it is what each organization has in its kitty. So put simply, it is not like the 400 million provided by the IDC is what is made available annually. No, that is the entire amount that is available. So it is a stock number. That please, I just thought to clarify that. So what this means then is that the annual funding or financing gap in exploration is even higher per annum than what we've presented here. So with such funding gap or financing gap, our view is that, which is a view that we've engaged some of the very important government departments, our view is that flow-through shares as an incentive scheme could bridge this financing gap. All we're looking for is just about 8 billion rands a year. So, but also, if you notice, I also included here talk of the section 12J of the South African Income Tax Act. This was introduced in 2009 to stimulate investment in sort of risky economic activities. And the objective really was to create more jobs. But there was also talk that that could also provide funding for exploration. Let me just tell you that it never did. It never attracted exploration funding. And it was also discontinued in 2021 because it was seen as very costly for the fiscus. It was also prone to abuse, and it was not delivering the expected sufficient economic benefits relative to its tax expenditure. So our view is that there must be a mineral exploration specific instrument that will unleash exploration as well as unleash the sector's potential. So then we have to ask the question, how has the decline in exploration spend affected one key variable? And that variable is this: how has it affected employment? Yes, there is no direct correlation between exploration expenditure and employment in mining. However, the connection is here. The relationship or correlation is here. Exploration will result in new mines. When there are new mines, there will be an expansion in employment. So what you see here, this is indexed to 2007, where the sector employed about 495,000 people. You can see the number of red blocks there. Essentially, by 2025 Q3, for which we have data for, the total employment in the sector was 25,957, lower than it was in 2007. I must really emphasize this point that the lack of greenfields exploration is a leading indicator to the formation or establishment of new mines. When you establish new mines, you're going to employ more people, and that has not been happening. Then, last word. Here, basically, perceptions matter. You like it or not, perceptions matter. How investors view South Africa does matter. And so here, and I'm about to conclude here. So here we're showing the results of the Fraser Institute 2025 mining survey as it relates to South Africa. To note is that the overall investment attractiveness index in 2025, South Africa was ranked 57th of 68 jurisdictions. And if you look at the chart of the 10 years that are presented, there, 2016 to 2025, 5 of those years we were ranked in the bottom quartile. That is basically the worst ranking. The other years were ranked in the 3rd quartile. That's what color is that? That is orange or yellow. We're ranked in the 3rd quartile, which is a poor ranking or poor performance. What we're aiming for, we should aim for that green red rectangle there for the top quartile. And that's why I've included there that aim to be here. We want to aim to be in the top quartile as it relates to how investors view us as a country in relation to investment in mining. We really want to have everything sorted out. And I'll talk about what we need to sort out. Here, this is the Policy Perception Index, and this is the most relevant one, I must say. Again, look at the chart there. In 7 of the 10 years reflected there from 2016, we have actually been ranked in the bottom quartile in 7 of the 10 years there. The other 3 years, we were just marginally making it. So when we say there's policy and regulatory issues, among other things, it's because of what is reflected in surveys such as the Fraser Institute. So we have to then ask, what are the policy factors that we really need to work on? Look, this is my last slide before I conclude. Here I'm showing the 15 policy factors and how we were rated, how we ranked or scored in 2025. That black vertical line there is a score of 50. In all 15 aspects, we were actually, we scored less than 50. Really not a good showing at all. I then included the +1 there, basically, which is mineral potential. Look how investors view us as a country in terms of mineral endowment. We scored just slightly higher than 80. So investors see a potential in us as a country. We have a diversified portfolio of minerals in terms of reserves. So we are up there. But however, these other policy factors are holding us back. And of course, I think we can engage on this maybe offline, but let me just conclude. So there are 5 points here. The first one is that given our mineral endowment, as a country, it is true we have underperformed. And that is why, again, going back to my theme, I said, this is really a sector with so much potential. The second point here is that as a sector, mining continues to shrink even as we have these reserves. Just look at the data. Sometimes people think that it's us as the mineral Council who say that, but it's just the data. This data we use is from independent sources. That's SA, SARS, from the World Bank, from the Fraser Institute. Just follow the data. This sector has been shrinking. It is smaller than what it was in 1994, in 2004, as well as 2010, as reflected by the indices that I've showed here. The fourth point is that there is a financing gap for exploration, and that needs attention. Among other things, the recommendation is flow-through shares. Have a mining exploration specific instrument that will catalyze exploration. And finally, perceptions do matter. We need, out of the 15 policy factors, it is very important that we identify the low-hanging fruit. We might not have to address all of them, but let's look at the major ones, address them as a country, steadily address them, and by so doing, we will attract the desired investment into mining. Thank you very much. That's my story.
Thank you, Bongani. That was quite informative. And colleagues, you can put your questions to Bongani on the Q&A tab. I think I did say chat before, but it should be the Q&A tab, and we will come around to it. There is one question that is up there. It's around what I've just lost my
Alex, yeah.
Okay, there you go. We will address some of the questions, I think, through the presentations, but the ones that are not answered through the presentations, we'll pick them up then in the discussion session later on. Bongani, thank you very much. If you can stop sharing, that would be great. And colleagues, the next presentation, Dr. Manikrit is going to take us through the results from the research study that he assisted us conduct towards the end of last year. Mani, over to you.
Hey, a warm welcome to this second presentation. Thank you very much, Alex, Grant, for the opportunity to share with the audience the work that we've been busy with in the recent past. So important, and I want to congratulate Bongani on a very well manicured presentation. The graphics, I need to be put in touch with his contacts in terms of the way that he put it together, and I think it's very pertinent, the information that he shared, and it really echoes what research I've been doing in the past 6 or 7 years in this space. So I'll get right into it. Thank you for the opportunity. So I think just a bit of background. I think right at the beginning and the introductions, we alluded to this, but I think it's worth saying that the Junior Emerging Miners Desk at the Minerals Council has conducted and contributed various studies in the junior mining sector in South Africa in the past 20 years. I was introduced to the Minerals Council somewhere around 2017, 2018, when we started discussions. And I think that first study that we also mentioned in 2019, that was then completed. It entailed a desktop study of all the relevant information, all the data sources that Bongani also used was part of that. And then also a survey that we conducted into the junior mining companies and the members of the Minerals Council of South Africa at that stage. It was also quite interesting that it's the very last slide on the Fraser Institute that Bongani shared. was also at that stage echoed by the conclusions of that 2019 study, where I think it was 68% of the respondents to the survey indicated that the regulatory environment, was 68%, was their biggest stumbling block, or that prevented them from really being successful in developing their projects. And then 20% of the respondents indicated that funding was a concern. Then I think also parallel to all of this, I conducted a PhD. I'm personally very invested in the junior mining sector. I'm passionate about the sector, the subsector, if we would like to call it that. And between 2018 and 2023, I conducted my research for the PhD. And the outcome was a proposed new integrated dispensation model to unlock the value-adding potential of the junior mining sector in South Africa. And I included some international comparison in that. This presentation, however, represents an update of the work that's been done previously, both 2019 and also to some extent my research on the PhD. We reviewed all the relevant information. Once again, that is the DMPR data and everything that's available in the public domain. And then also very important, interviews were held with quite a number of junior mining CEOs and industry forums, which I will share with you some of those feedbacks. And then interviews with some of the financial institutions. So it dovetails nicely in terms of what Bongani has alluded to, and my colleague Francois that will present after me, that the investment space for mining. So that's a bit of background. So I'd like to start off by saying it always starts with why. Why are the junior and emerging miners important in 2026? The whole discussion around exploration, we all know that South Africa has a very, very strong 150 odd years of successful mining. The very space that I'm sitting in today, we're based here for the presentation here in Rosebank, next to Johannesburg and Sandton. We know this city has been built on the foundation of gold and mining, which would never have been had it not been for mining. In 2010, Minister Shabangu at the time was quoted as saying that 80% of the global exploration spend was coming to South Africa at that stage. The DMPR reported less than 0.5% in 2024, so a dramatic change. Traditional mining houses did exploration in-house in that 150 years of success in South Africa. We built a number of successful big mining houses, which developed the balance sheets that could actually fund exploration in-house. Up and coming juniors and mid-tier mining houses simply don't have those sort of balance sheets to explore at the same level. So that's maybe one of the reasons why we've contracted from 8% to 0.5%. It takes decades to establish the likes of an Anglo American, a BHP Billiton, the Goldfields, and the like. S&P Global Market Intelligence shows that the duration of developing a mine is between 15 and 20 years. So it's not a short-term investment, and we know it's very capital intensive. Estimated global population growth is headed towards 9 billion people to 2040, only 15 years away. Another billion people is estimated to be added to the global population. Research also shows, and I've been tracking these numbers for the past 7-8 years, that the average person consumes about 1,400 tons of minerals, metals, and fuels in their lifetime. So what does that population growth of 1 billion people equate to? It really comes down to 1 quadrillion 960 trillion tons required to serve these humans in the next lifetime, which is probably anything between 65 years heading upwards in terms of life expectancy. The question that I'm asking is, do we have enough new mines and alternatives in the global mining project pipeline to meet the demand? And what, to add to that, what role must South Africa play with its wealth of mineral endowment? That's a graphic that really paints the picture. It's the research that's done in the States and it's maintained for many years. So it's quite a fun picture just to make the point. Then on my next slide, which is also very fundamental, in my research, I've discovered that we are not always measuring with the same ruler when it comes to the definition of what emerging and a junior miner actually is. So the Minerals Council has done excellent work in actually developing a definition for this sector. And my suggestion would be that if we are going to measure with the same ruler across different departments, government departments, we should actually consider standardizing our definitions and to adopt the Minerals Council the definition. That I expand on in previous reports as well. So just looking at that right to the front end, the prospectors, the mine developers, sitting on the left hand of the definition, everybody listed here as part of this definition are actually legal operators. It does not at this stage include artisanal illegal mining for obvious reasons, but we know it's a pertinent area of mining that needs serious attention. Then also looking towards the micro mining all the way to the medium scale miners, I think what I want to highlight here is typically let me just put on the laser pointer, some of the numbers that's been highlighted, where there's good alignment between the definition of the Minerals Council and some of the numbers shared by Stats SA, SARS and the like. So there's good alignment in terms of these revenue numbers that actually supports the definition. And then also just the number of employees is very important to understand that. So below 150 employees, micro mining, 250, 500, and then on the on the right-hand side are your large-scale blue chip typical miners and the definition of that. So the point being, we need to have a look at standardizing the definition, and the amount of work that the Minerals Council has put into this, I think, really warrants a serious consideration to make this the standard for defining these sectors across the spectrum. Then South African juniors have a broader focus than their international peers. If we look at this, call it mining value chain, simplified as it is, from discovery, exploration and feasibility type studies, construction, and then mining extraction, beneficiation, then the logistics and marketing and sales side of it, and then rehabilitation and closure as an example of the value chain. Traditional international junior miners tended to focus on the discovery and exploration side of things, at which point they often would sell their projects to other interested parties. However, our research has shown that the South African juniors' aspirations are much greater. Most of the South African juniors that we've engaged in our interviews have indicated emphatically that they have aspirations to actually build mines, construct the mines, and even be in the game all the way until mine closure. So that's a fundamental difference in terms of when we refer to junior miners in South Africa compared to international, our colleagues in Australia, Canada and the likes. Then I think also at the first study in 2019, one of the very pertinent conclusions of that report was South Africa has a dire need for job creation, and that the junior and emerging mining sector can play a significant role in creating jobs. It's a primary industry, mining. It has a number of benefits in terms of our population and even education levels in South Africa. That is the ideal area where we should be creating jobs. So just on this graph, you will see on the left hand to 2021, about 90% of jobs were created by the majors, the large established mining houses. About 404,000 jobs were sitting in that space. And that has actually, in terms of percentages, decreased to 88% in 2024. Yes, in terms of real numbers, a small increase. But as a contribution to the total sector, I want to show that the junior and the small miners has actually shown an increase from the 6 and a 4% to a 7 and a 5%. So there has been growth, and that is significant for the junior and emerging mining sector. So there is growth in terms of job creation in this subsector, which is really positive. So there is some positive movement in the number of jobs that's created in this early developmental stage of the next big mine. Then, in terms of the financial trends, comparing the numbers for 2018, so the green bar really represents the revenue, and we can see that there's been an uptick since the previous study, 2018. The revenue has increased significantly until 2024. The cost has also grown. You can see that in the red bar. But yes, I think the net profit before tax has been under pressure. And yeah, there was a nice uptick in 2022, but it has been reduced again in 2024. And we know a large proportion of these companies are in an early developmental stage and not necessarily in a position to make profits. So yes, what is positive from this graph is the growth in revenue, the contribution that the junior and emerging miners are making in terms of the revenue that they are generating. Just a side note at the bottom here, mining and quarrying constituted 24.4% of company taxes assessed by SARS in 2022, which is significant, important industry. Then maybe a look at just on the regulatory side again, the licensing and permitting in South Africa. A lot of information on this slide. You can see the province broken down in terms of majors, juniors, small scale, micro, and the likes. And there we can also see the totals. So in total, 2,065 mining licenses in circulation in South Africa. Of that, a significant number sits in the junior space. Only 23% of mining licenses are in the hands of majors in terms of the Minerals Council definition. The rest are all up and coming in terms of where the licenses actually sit. These are mining licenses and mining permits. An estimated 5,000 odd prospecting licenses are issued in South Africa as we stand. In total, just north of about 7,000 permits. And I must also highlight that, yes, I had to do some fancy footwork in terms of the calculations. Although there's good data on the mining licenses, the 2,000 odd mining licenses from the DMPR, I could not lay my hands after numerous efforts on the same sort of information for the prospecting licenses. there's simply not a database available. Having applied for the information from the DMPR, complied with the PIA requirements, simply no feedback after making that formal application. Had some meetings with the department. There isn't a database, to my knowledge, that actually support these numbers, which is quite worrying considering that we are busy with a cadastre which actually requires sophisticated data in that space. Then moving on to the funding discussion, and I won't spend a lot of time on this because I think Bongani has touched on it and Francois will follow with some in-depth analysis. But if we look at this mining value cycle from early exploration, pre-development, all the way to mine construction and then mine production, there's a very fundamental point of where a pre-feasibility study needs to be conducted. And in terms of the reporting codes, SAMREC, JORC internationally, National Instrument in Canada and the likes, this is the point where a mineral resource can be converted to a mineral reserve. And that's quite fundamental and a key point. So how do you reach that point where you can actually declare reserves, and that will then take you up the value curve quite significantly. So before that point, and that's the challenge in exploration in South Africa, but also globally, is the availability of funding in that space. It requires what we fondly refer to as the FFF, friends, pools, and family, that does the funding at that stage. A very positive development is the Mining Exploration Fund, the 400 million that's been available, although it's very small. It is a start and a very positive start in 2024-25. And then there's venture capital on a number of stock exchanges, Canada being very well known for their venture capital bourse on that side of the pre-feasibility line. Very limited options, although very important. Also associated to a higher risk profile at that early stages. Then moving towards feasibility and the construction, there's a number of options: equity, the IDC, private and stock markets. There's debt financing, the banks, IDC. There's venture capital on the bourses, also other capital on these stock exchanges, and streaming and production hedging. So the options becomes broader and more abundant once you've reached that critical point of pre-feasibility. So that's quite an important takeaway, is to support these discoverers of the future mines to get the funding to actually get to that point where it doesn't become easy, but it becomes easier to develop their projects. So early stage developments, and Bongani has already in his graph showed that gap between what is required to get to the 5% and what is available. So maybe just digging in, and I want to invite you to get a hold of the report that will be distributed. The Minerals Council will communicate along those lines. But there's quite a detailed analysis, and it was quite insightful to see how this DMPR, IDC, and the Council of Geosciences Exploration Fund was practically rolled out in the past 2 years. So phase one had a first window that ran between April 2024 and March 2025, and 160 million of the 400 million was allocated. The commodities that were considered were copper, nickel, lithium, graphite, and rare earth elements. There were 119 applications for that funding, which actually equated to a need of about 3.7 billion from these 119 applicants. 46 applications were eligible in terms of the rules that were applied. You can read the details in terms of what those rules and considerations were in the detailed report. And the 46 applicants that were eligible actually needed 1.1 billion. 8 of the 46 were successful and allocated the 160 million. Then phase 1, window 2 opened in April of last year. And that will be the next 240 million that's allocated for that initial 400 million fund. And there's also some details in terms of how that window 2 will be handled differently from window 1 in the report. Then just high level, I think post the completion of my research report, there were quite a number of significant developments. Around October of last year, the PIC fund was announced, 1.35 billion for these early stage mining projects. The Anglo-American Junior Exploration Fund was also mentioned around the same time, 600 million. And then the BHP Explore, we're running in its 4th year, a 9-month accelerator approach, has around about $500,000 available for applicants, and some we know of at least one South African company that was successful in their application for those funding. So that is more or less to the left on my previous slide. At early stage funding that we know of and that is available. Then mining capital raising on stock exchanges. I won't go into a lot of depth here, but just to give an order of magnitude. So listings in terms of market capital for your juniors between 2023 and 2025. So the Toronto Stock Exchange has the most listings, about 880 odd. Australian Stock Exchange, about 720 juniors listed there. Then in London, about 180 and so on. And the JSE, only 12. And I must say that is an improvement from the 2019 figures. So yeah, there has been some development. But capital raising for junior mining projects are not necessarily done in South Africa. You can see if the stock market is where you want to raise capital, it's probably Canada, Toronto, and Australia. And there's just as a matter of interest, also the scale. In 2026, the Mining Indaba in Cape Town was quite a successful event, attracted about 12,000 attendees. PDAC in Canada attracted just after Indaba. It always follows Indaba about a couple of weeks after Indaba. PDAC in Canada attracted 32,000 attendees. So it also speaks to the quantum of interest in Canada. And the big difference, I think, is Canadian government way back in the previous decade, even way before that, introduced flow-through shares that Bongani has also alluded to, that really forms the foundation of the strong growth in terms of junior mining in that jurisdiction. Okay, so then I want to share with you some discussion around what the interviews that are held, the themes and that materialize from those discussions. What our junior and emerging miner CEOs and some of the organizations affiliated with the Minerals Council, the feedback that we received, that is well explained and the details followed in the report. So I think first, the cost of compliance has become untenable for these South African junior miners. That was a big theme in many discussions that I've had. So yeah, some of the themes that the CEO shared with myself was that mines are expected to fill the void left by local governments, have to build roads, schools, hospitals, water supply, security, and the likes. And the pertinent question that these junior miners ask is, where does the responsibility of a mine stop? And where does government's responsibility actually start? The DMPR is perceived as all stick and no carrot. That was quite a significant feedback that a number of the CEOs shared. Regulatory benchmarks too high for an emerging economy. Some examples are the changes in legislation on the 500-meter blast zones, the level 9 collision avoidance requirements. Junior miners highlighted that it's simply just too costly and even negatively impacting productivity. There's one standard for majors and small-scale miners, and they are simply asking the question, can there not be a special dispensation to get this very important part of your development, the exploration side of things going? And then also a number of juniors, we know cash is very, very important, and cash flow implications of the juniors of those rehabilitation guarantees that they need to put up front, and they simply asking, can there not be a rethink in terms of the period in terms of where they need to meet those guarantees? Then significant increases of cost of mines, of failing national infrastructure, the whole discussion around power and rail and ports and water and policing and hospitals. It has loaded the cost line for these junior miners, and they shared some significant numbers in terms of percentages that they see in terms of their financial management. Then criminality, cartels, mafia, and corruption. Well, the SAPS is ineffective. That's the broader feedback that CEOs shared with us. And the question is now raised, will this military intervention succeed in making a difference? That's the question. Artisanal and illegal mining to the minds of our CEOs are much easier than doing the right thing, and it's actually killing industry. Examples were shared where an inspector would drive to a mine, passing 30 illegal operations, coming to a mine and issuing a Section 54 mine stoppage for a mine that is actually trying their best to actually meet all the legal requirements, whilst the 30 illegal miners don't have those concerns whatsoever. So it's very easy to be an illegal miner in the minds of our junior and emerging miner CEOs. South African mining is becoming uninvestable for global investors. That is a theme that was shared from many of the interviews that were held. The DMPR is clinging to power at the cost of aggregate sand and clay producers. So the example that was shared was that if there are borrow pits created for road construction, these borrow pits are actually governed by a different Department of Public Works, with completely different rules than our aggregate and sand and clay producers have to comply with. And the question was asked, from their perception, it would be better to put these operations of aggregate, sands and clay under the Department of Public Works, because it appears that there's two standards in terms of what they need to comply with. Juniors then also need easier access to derelict mines. We know there's quite a number of derelict mines in South Africa and operations that are on care and maintenance. So that was also one of the themes that emerged from discussions. And then one of the other key themes was also, again, on the back of the work and the feedback in 2019, the work of the Fraser Institute, and I like it that Bongani mentions that perception does matter. We can argue that the Fraser Institute is a Western, Canadian-based research facility with maybe some biases towards what's happening. But we cannot escape the fact that there is that perception, and regulation has become clumsy without accountability from the DMPR, is what our junior CEOs are saying. They are asking who has the back of the mining company in South Africa, the miner, the mine manager. Who's got the back of the mine manager in South Africa? And that it is perceived that the DMPR, it serves all the outside stakeholders, the municipalities, the communities, the NGOs' interest before those of the mines and the mine owners. Is that right? Is it wrong? I cannot have an opinion on that, but that is certainly the feedback that our mining CEOs have shared in the interviews. The DMPR is also in constant flux with regular name changes that is very confusing. And does not increase the confidence for investors. So there's also a bit of details in terms of how regularly the department and the acronym has changed in the past 10 years. And then a total reset may be required if we were to move the needle on building new mines in South Africa. Bongani has shared the downward trends, I think, from 2004 thereabouts. The question would be what happened between 2004 now in the regulatory space? What are the reasons for the decline? Although we see that, yes, South Africa is well endowed and does probably have another 150 years of success in mining ahead of it, of us all. If we can get the exploration and the junior mining sector going. Then, and I do apologize, the next couple of slides are very text heavy. It's also a pet hate of myself is presentations with so much text. But I think the case study that I want to share with you does have a lot of lessons of a PGM project that is 21 years in the making and currently at the bankable feasibility state. So you will recall that I mentioned S&P Global mentions that building a mine is a project between 15 and 20 years. Here's an example in South Africa of a mine that's been busy, or a project owner for 21 years and hasn't started construction yet after 21 years. So first, this project started in 2005 where the old order mine prospecting rights were converted to a prospecting license, new order. It has a 50% partnership with local community, really a success story in that instance. A significant advantage for the project given that the engagement was with a single, clearly defined community structure via a traditional council. That is something that also in discussion with the mining CEOs came out strongly, is in some other instances, there are multiple communities that needs to be engaged with and has become unmanageable for the simple junior miner to comply with those. So in this instance, yes, I think this project was fortunate to have one community to engage with. Then between 2007 and 2014, there was some legal action. The DMR awarded a prospecting license to another party on the same prospect. Then the DMRE, just note the change in the acronym, cancelled the wrongful prospecting license of the other party. Yet 1 month later, the prospecting license is again awarded. So to the same party. Case taken to court. There has been appeals in Bloemfontein. Ultimately, the court ordered the DMR to cancel the prospecting license to the wrongful party, and at a tidy sum of about $2.2 million with senior counsel all along the way between 2007 and 2014. because of a double allocation of the same rights on the same property. So yes, who's picking up that bull? That's the question. Ruling in favor of the applicant was then made in November of 2014, and the project could then move forward after losing 7 years. In June of 2015, the prospecting license was granted. Lost investors during this period. You will imagine that there's a lot of effort going in getting that critical mass going of engaging with multiple investors, but that was then lost. The owner incurring huge legal costs, something that should never have taken place in the first place. And then the second round of funding roadshow started. This project owner met with 150 odd investors in 2015 with no success during the last Zuma years, as he would word it. Then in 2019, the PGM market improved and they started roadshows again, and one-on-one meetings at the mining Indaba started. In 2020, initiated the investor discussion in Australia, and then also the difference between the previous report that was published in 2019, the small matter of COVID-19, happened in 2020, and brought a halt to everything. We couldn't travel. We were sitting at home on Teams meetings. Continued preparations for listing in that period on the ASX and the JSE for a dual listing. Then moving forward to February 2022, there was an extension granted for 3 years on the prospecting license. In June of 2022, the company listed on the ASX and raised 19 million Australian dollars. It's a bureaucratic process. And the funds were held in escrow for almost 2 years. And then, due to that process, it necessitated a listing on the JSE as well. On the 8th of June of that same year, 2022, the company listed on the JSE, but didn't raise any funds on the JSE. After sorting out the issues with the reading panel, and related to the resource estimation, that listing was concluded. Then for the period August 2022, 2024, they completed some significant infill exploration drilling, 33,000 meters. That came at a tidy sum, once again needed funding, which they fortunately secured to some extent in Australia with the listing. 28 October 2024 announced a pre-feasibility study. That significant point that I highlighted, where reserves can be declared. That happened in October 2024. And then in May 2025, they received environmental authorization, applying for mining license. Some of the lessons that were learned was it was better to separate the applications for water use license and waste management, and not to handle it as a single application. So they did split the applications. It was very time consuming dealing with the departments, water affairs and forestry and fisheries and environment. I identified the shortcoming in the legislation on practicalities between prospecting right and mining right. Just in that mining right. So it is still unclear what drilling can continue to be done post your prospecting license. No resource drilling is allowed, but metallurgical and geotechnical drilling is allowed. That was one of the lessons. And then in June 2025, they raised another 8 million Australian dollars with additional 20 million Australian dollars in October of that year, with share placement on the ASX, which improved the PGM, the improved PGM prices assisted. And then they completed the infill drilling, performed the optimized PFS. So I think towards the end of last year in September, they expected the mining right at that stage. I'm not clear if they have been successful just yet. The idea was in the second quarter of 2026 to conclude the definitive feasibility study, and then to consider debt finance of 160 million US and streaming for future funding. Conversations with high net worth individuals and risk capital were much easier in Australia than in South Africa, where it is mentioned that it's virtually impossible or a non-starter. And then maybe a couple of stumbling blocks on this case study. In the many roadshows, and in particular in 2025, this project owner went to the US, spoken to a number of investors, where these investors recognize the technical value of the project, very happy about the technical work that's been done and the quality. But the one phrase was, how do we handle South Africa? We don't know. And they are sitting on their hands as we speak. Bureaucracy in dealing with the various government departments, it's slow, it's adding additional cost. That hasn't changed since the report of 2019. That's the perception and the feedback from this project owner. Criminal syndicates is a huge threat, and that our police services are ineffective. I think the deployment of the military speaks to that. There's recognition by government that this is a significant problem that needs to be addressed, and it's welcome that there's some action taken. So we're very hopeful that a change can be achieved. And then I think the ambiguity in legislation leads to misinterpretation or flexible interpretation used to bully juniors. Legal costs for handling these ambiguities are astronomical and quite often requires input from senior counsel and opinions. And that was one of the during that period, 2007, 2014, for this client, that was very costly and really brought them back to zero to a large extent once that was sorted out. And then this client also said that the DMPR has well-published timelines for responding to applications, but they do not stick to the timelines. The DMPR regional offices have piles of disorganized files filling their offices. It's problematic. There's delays in implementation of the mining cadastre, and this will have a direct impact on when international investors return to South Africa. It is estimated that a fully functional system may take another 5 years, and not as the expectations are that it is busy being rolled out. That's the one of the other stumbling blocks that were highlighted. So I think in conclusion, really there's been growth in the junior and emerging miner sector that is really positive. This is a sector that holds the key for the future. The exit of the blue chip mining companies from South Africa has left a significant gap in terms of how exploration is funded. And that gap needs to be made up. And a number of mid-tier and junior mining companies are stepping up, but the regulatory environment and the investment into South Africa is still problematic and needs to be addressed. That's it from my side. Thank you very much for your attention.
Thanks, Mani. That was indeed very informative. It just begins to scratch the surface of the challenge that we face when it comes to not just exploration, but the entire universe of junior mining. And we know, it's the policy environment, it's regulation, but also it is funding. Hence, we have now Francois to take us through what he came up with as part of the work that he was doing towards satisfying a requirement for his degree in the universe of mining and how mining can be funded. Francois, what to you?
Good morning, colleagues, and thank you for the introduction and the opportunity to present my research findings. My dissertation topic assessed the financing challenges faced by junior mining companies. I will briefly discuss the background of junior mining companies and why they face financing challenges. I will then discuss the financing options that are considered, the project life cycle, the commodity cycle, and the demand for minerals. This will be followed by the research objectives and a discussion of the research findings. Lastly, I will discuss the recommendations that emerged from the findings. South Africa possesses some of the richest untapped mineral resources in the world. Yet, many junior projects never progress beyond scoping or concept. The challenge today is not whether we have the geology, but whether we have the right financing strategy to turn the mineral potential into operational mines. Mining projects require extensive infrastructure, and these developments often take many years to complete and require billions of rands in capital investment before revenue is generated. The lead time creates significant financial pressure, particularly for junior mining companies with limited balance sheets. Historically, the mining industry was dominated by large mining houses, which had the balance sheets to finance mining projects from exploration through the construction phase until operations could commence. Over time, the industry evolved, and large mining houses began to unbundle and focus on specific commodities, while exploration and early-stage development increasingly shifted to junior mining companies. Today, many prospecting and mining rights in South Africa are held by these junior mining companies, and they play a critical role in discovering new deposits. However, they face a major challenge in securing financing. Exploration projects carry high levels of uncertainty. As a result, traditional funding sources are often hesitant to invest, particularly during early stages when no cash flow exists. Junior mining companies must therefore rely on a variety of financing mechanisms, such as equity financing, debt financing, streaming agreements, royalty agreements, and convertible instruments. Equity financing is the process of issuing a portion of equity to investors in return for capital to fund the project. The biggest advantage of this method is that there is no need to repay the investor. However, it leads to dilution of investors. Debt financing is the process of borrowing money to fund the project and paying it back with interest. The advantage of this method is that the lender does not have any control over the business, and once the loan is repaid, the relationship ends. However, debt is an expense and it can disrupt company growth. Streaming is an upfront cash payment where the investor secures the future production of a metal at a discounted, agreed-upon price. Royalties, on the other hand, is an upfront cash payment and the investor receives a portion of the revenue generated. Convertibles are long-term debt that can be converted to equity stock after a predetermined period of time. To understand the financing challenges, it is useful to consider two important cycles: the mining project life cycle and the commodity price cycle. A mining project typically progresses through 5 phases, which are the concept phase, the discovery phase, the feasibility phase, the development phase, and the startup phase. The concept phase, which involves the initial exploration to determine the potential of the property with the aim of attracting investors to allow further exploration. The second one is the discovery phase, which includes drilling to assess the extent of minerals beneath the surface. The third phase is the feasibility phase, which consists of financial and engineering studies to determine the viability of the project and its potential profitability. The fourth phase is the developmental phase, which requires a considerable amount of capital investment in order to transform the mineral deposit into an operational mine. The fifth phase is the startup phase, which is the transition from development to production, where the mine starts to generate revenue. Each phase carries different levels of risk, capital requirements, and financing options. As seen on the Lassen curve, indicating how value and risk evolve across the mining project lifecycle from concept through to stable production. Starting on the left, during the concept and discovery phase, we see what is known as speculative investing. At this stage, investors are funding geological potential rather than proven economics. Uncertainty is high, but so is the upside if the discovery is made. As the project moves into the feasibility phase, confidence increases and the project typically reaches its peak valuation. However, this is also where speculators begin to exit, taking profits and often causing a decline in value. We then enter the developmental phase, commonly referred to as the valley of death. This is a capital-intensive stage with high funding requirements and limited revenue. The project is often too risky for institutional investors and no longer attractive to speculators, resulting in a reduced valuation and funding pressure. As the project progresses into startup and stable production, risk decreases significantly. At this stage, institutional investors begin to enter, driven by improved certainty, defined reserves, and the potential for consistent cash flows. At the same time, the mining sector operates within the commodity cycle, which adds additional challenges when securing financing. The commodity cycle also has 5 distinct phases, namely the boom phase, the peak phase, the downturn phase, the trough phase, and the recovery phase. The boom phase is indicative of a high demand and limited supply, which results in higher commodity prices. During the boom phase, revenue increases and investors are eager to contribute. The peak phase describes the situation when commodity prices reach the highest level in the cycle. Companies invest heavily in exploration and development during this phase. The downturn phase is characterized by a decline in commodity prices as the supply is sufficient while the demand begins to decrease. This will result in a decrease in revenue and an increase in the difficulty of accessing financing. The trough phase is when prices reach the lowest level in the cycle, which is caused by an abundant supply and a dampened demand. During this phase, mining companies face financial difficulties, but it provides a great opportunity for strategic investment. The recovery phase is indicated by a gradual increase in the demand and a decrease in excess supply. As a result, the commodity price begins to gradually increase again, and there is an improvement in the financial performance of the company. These cycles directly influence investor confidence, project valuations, and the availability of funding. The global shift towards electrification and renewable energy is creating a major increase for demand for minerals. In 2022, the International Energy Agency forecasted that by 2030, the capacity of renewable energy should be doubled to meet the requirements, and by 2050, an increase in 291% from the 2022 requirements. The agency projected in 2022 as well that over $1.7 trillion would need to be invested over the next 15 years in order to supply the required raw material. Another study done in 2025 found that 293 new mines would be required in order to keep up with the energy demand. For example, they found that lithium would require 52 new mines before the end of the decade, and copper is in a similar situation, with 61 new mines required by 2030, as the projected shortfall is 4.7 million tons of copper metal. This presents a major opportunity for South Africa, which possesses significant deposits of these critical minerals. However, despite this opportunity, access to financing remains one of the biggest constraints for junior mining companies. In order to explore this challenge further, I conducted interviews with industry professionals to assess the following objectives. In order to determine an acceptable debt-to-equity ratio for junior mining projects, identify the most appropriate financing option across the project lifecycle, understanding how the commodity cycle influences financing availability, evaluate the accuracy of project valuations and cost estimates, and to identify strategies that can make junior mining companies more attractive to investors. One of the most consistent findings from participants was that the acceptable debt-to-equity ratio increases as the project progresses through the life cycle. During the early exploration phase, debt is generally not viable. There is no cash flows and the geological uncertainty is extremely high. As a result, equity financing becomes the primary funding source. As the project advances into feasibility and development, the ratio can increase to 10 to 40% debt. During the construction phase, it can increase to 40 to 60%. And once it reaches the production phase, it can increase to as high as 60 to 80%. This progression reflects the decreasing risk as geological certainty improves and cash flows become more predictable. The participants felt that the commodity cycle did not have such a great influence on this ratio. The two biggest contributing factors to these ratios were the project flow projections and lender-imposed conditions. Participants strongly agreed that equity is the foundation of early-stage financing, as there are no obligations to refund shareholders, and it preserves flexibility during risky situations. The major advantage of equity is that it does not require repayments. However, it results in shareholder dilution and increasing return expectations from investors. Debt financing, on the other hand, is typically the lowest cost of capital, but it only becomes available once a project demonstrates strong fundamentals. These generally require proven reserves, a bankable feasibility study, mining rights, and adequate project scale. Most participants identified streaming and royalties as viable options throughout the cycle. Streaming and royalty agreements provide upfront capital without immediate repayment obligations. However, participants noted that these structures can become expensive over time, as they effectively represent a long-term share of future revenue. Convertibles were also identified as a useful instrument, particularly during periods when traditional financing is limited. While the interest payments are tax deductible, conversions to equity often occurs at a discounted price, making them potentially dilutive and expensive. The research confirmed that the commodity cycle has a major influence on financing availability and cost. During the boom and peak phase, financing options will be readily available and notably cheaper than during other phases. Equity and debt financing are the most accessible, which makes it the ideal time for junior mining companies to reinforce their balance sheets and advance projects. It is less dilutive as equity prices are higher, while investors have a strong appetite for risk. Debt providers are also willing to provide more funding as the higher commodity price improves the projected cash flows and reduces the perceived risk. However, once the cycle enters a downturn phase, conditions change rapidly. During the downturn phase, it becomes difficult to raise funds and equity becomes more dilutive as a result of lower valuations. Debt lenders become more cautious and base their forecasting models on more conservative terms. While debt is not completely absent, it does come at a higher cost and stricter terms. Alternative options such as streaming, royalties, and convertibles become more preferable. The trough phase represents the most challenging environment. During the trough phase, there are severe limitations on financing availability. The investor's appetite for equity is almost non-existent, project valuations are low, and equity is highly dilutive. Streaming, royalties, and conservatives become more prevalent as these options reduce the risk for investors and provide junior miners with the necessary liquidity. Only high-quality projects with world-class deposits and experienced management teams will be able to raise funds during this phase. During the recovery phase, financing conditions gradually improve. Equity investors often return first, followed by lenders as commodity prices forecasts strengthen. Junior mining companies can cautiously begin to raise less diluted equity again. Debt lenders remain conservative, however, their appetite increases as projections increase. Alternative options become less attractive. Most equity investors are pro-cyclical and would return faster than debt providers. Across all phases, participants emphasized one consistent theme: project quality and management credibility can significantly influence financing outcomes, regardless of the commodity cycle. The general assumption is that theoretical project evaluations is not aligned with actual project costs. As a project progresses through its life cycle, the accuracy levels of the capital estimates improve. At the exploration phase, the accuracy is approximately only 30 to 50%. It was noted that junior mining companies often overestimate their capabilities and underestimate their project's complexity. The accuracy levels increased to 25 to 30% in the pre-feasibility phase as the studies reduce the uncertainty. Once there is a definitive feasibility study, the accuracy levels increase to 15 to 20%. It was found that 83% of mining projects experience scheduling and cost challenges. The capital overruns were approximately 40%, with scheduling delays of up to 20 to 30%. It was suggested that junior mining companies should underpromise and overdeliver and avoid overselling early estimates and be clear about the levels of accuracy. Investors value honesty, clarity, and consistent updates. Clear communications reduces the perceived risk and avoids eroding the confidence of investors. Junior mining companies can also start phase mining in order to prove their capabilities and to generate cash flows. Importantly, junior mining companies should focus on high-grade deposits with fundable, realistic balance sheets. Junior mining companies should keep balance sheets simple and avoid complex debt structures. All participants noted that the management team and leadership are of the utmost importance. The financing options available for junior mining companies are also heavily dependent on the quality of the ore body, as investors will look very closely at the geological aspects of the deposits. A world-class ore body will attract investors at an early stage, whereas a marginal project will always struggle regardless of the management team. Based on these findings, several recommendations can be made for junior mining companies seeking to improve their access to capital. Junior mining companies can adopt a phased approach to capital requirements. Rather than attempting to raise funding for the entire project upfront, companies should structure projects in incremental developmental phases. Prioritize high net worth individuals and look at potential listings in early stages if you have an inferred resource. Early stage exploration is inherently risky and often unattractive to institutional investors. These options mentioned above generally have a higher tolerance for risk. Junior mining companies should strengthen the management team with demonstrated experience. The credibility and experience of the management team remains one of the most important factors in securing funding. They should develop strategic offshore financing networks. Given the relatively limited exploration financing available locally, junior mining companies should actively engage with international investor markets such as Canada, Australia, and the United Kingdom, where mining investors are more familiar with early stage projects. Junior miners should align financing instruments with the life cycle phases. Different stages of the project life cycle requires different financing structures. Align financing strategies with the project risk profiles improves the probability of securing capital. They should adjust financing strategies to the commodity cycle as well. Junior mining companies must recognize that financing conditions are cyclical. During boom periods, companies should strengthen their balance sheets and secure capital when financing is more accessible. During downturns, alternative financing options and joint ventures may become more appropriate. They should improve value realism and investor communication. Companies should adopt conservative valuation models, communicate clearly with investors, and rely on independent technical validations where possible. Transparent communication improves credibility and builds long-term investor relationships. Junior mining companies should proactively manage jurisdictional and regulatory risks. They should allocate resources to ensure compliance and engage proactively with regulatory bodies. They should enhance investor education and market familiarity. It is important to educate investors in order to align their expectations with geological realities and thus create a healthier funding environment where long-term discovery is prioritized over short-term speculations. Integrate risk management and ESG principles into the financing strategy. ESG commitments are increasingly becoming a prerequisite for investors and can differentiate a junior mining company from competitors in a competitive market. In conclusion, junior mining companies play a vital role in the future of mining industry by discovering and developing new mineral deposits. However, access to capital remains one of the most significant barriers, preventing these projects from progressing into operational mines. The research shows that successful financing strategies depend on three key factors: aligning financing structures with the project lifecycle, adapting strategies to the commodity cycle, building credible leadership, transparent communication, and strong project fundamentals. If these principles are applied effectively, South Africa's junior mining company sector will be positioned to unlock its vast mineral potential and contribute to the global demand of critical minerals. Thank you.
Thank you, Francois. Your presentation makes it look like an uphill battle, but it is. Moani was talking about short summers and long winters. That is when you are already mining. It can be a very, very long winter when you are exploring. It can be very, very difficult when resources run out. 2 decades of trying to find, or obtain your first ounce of PGMs or gold, whatever. That's a very, very long time. And as we know, not more than 5% of exploration projects actually deliver an operational mine. So the game that we are in is a difficult one, but the saying as it goes remains valid, that if it is not grown, it is mined. So we do need to look after this sector and ensure that everything is in place for it, from a regulatory environment that is permissive, to financing, to actually that advocacy that we need from all the key players in the investment universe. But on that note, colleagues, before we go into a discussion, as you know, you've all been muted. So please do put your questions on the chat box, and then we'll direct them to the speaker that can address the particular question that you have. Camilla, Gina, can we quickly run the quick mentor survey? Colleagues, we're just going to do a quick mentor survey before we go into the discussions and while we collate Q&As that might have come up. So please just go on your devices onto menti.com. The code is in front of you, 65845238. We would normally also have a QR code. It has gone AWOL. So you just have to type in menti.com, and then we will quickly go through a couple of questions that one will help us improve the way that we host the webinars. So,
the Mentimeter survey it's dead simple. It's basically 7 questions, and then there are comments, and you simply, for those who haven't used, and I'm sure most of you use Mentimeter, once you've done your comment, you just enter it, and then you go on to the next question. And if you don't want to make a comment, you can just skip. But it's dead simple. But we really value this feedback because it gives us an idea on how effective this webinar is. Thanks. The presentations will be available for sharing. Everything's going to be released next week, Wednesday.
Wednesday is April Fool's Day, so we're not going to promise you anything for the 1st of April. So everything will be released on Thursday, the 2nd of April. And Dana, please go ahead. Or is it Camilla? You can run through the survey, please.
Just give them a
Now, will you
chance.
share on your end, please?
Okay. Camila, you want me to do something I wasn't prepared
Yes,
to do?
Camilla, I'll be sharing.
Is it Camila that's sharing?
Yes, she's going to
Yes.
share now.
Okay, perfect. Tip top, tip
So
top.
loading on
There
my
you go.
side. Accept
Perfect.
all. It's still loading. These are the results.
Do you want to run through the results now? Or do you want us to run through the questions?
I'm just through the questions. I'm
Okay.
only
Okay, I'll share the questions.
okay.
There we go. Should I move through?
Yes, please move on to the next one. In fact, that is the first question.
But
No, don't do anything. Okay, don't do anything there.
Just go back to the results.
Okay, Camilla and Tina, maybe just go back to the results because that's the screen that everyone's works on, but
Okay.
individually.
all
Okay.
right, I'll share the results.
Okay.
Can you see my screen?
Yeah.
We can see your screen.
Okay, this was
All
the
right.
first question.
Okay, let's move on to the to slide 4.
Right, let's
Slide
look at-
4.
No.
Yeah. Thank you very much. Let's move on to slide 6. We will look at the detailed responses, colleagues, on our side. It will be for housekeeping and for us to just make sure that we do improve where we need to improve or address those areas that have not been addressed. And while the Menti is running, and Grant will talk to this. This is our first webinar for the year, and the plan is to have 3 of these and spread the word like wildfire, because these are open webinars and they are part of the sharing of experiences between our members and anyone else who is interested in the space of mining, particularly those who are either emerging miners or juniors, or who are in the exploration space. Thanks, Camilla. Let's go to slide 10. And as part of really understanding this, please do go to our website and go to the area that has got resources for junior and emerging miners. There's quite a lot of information that is there. And if you do come across areas where you want to contact us, please do so. Grant Mitchell will be your first go-to person. His email is in the chat box. We'll also put it up later on. And then let's go to the last one, colleagues. The slide, then it will be 12 and 13. Grant, you've got a lot of work to do in terms of what we do. And yeah, that's the last one. As I was saying, there will be 2 more webinars for the year, but we'll communicate that and we'll probably find ways of using a bit more social media as an outreach tool so that we can reach all of you. But you're also more than welcome to spread the word. Colleagues, the next segment then is for discussion. On my side, I do not see any new questions other than the ones that have been addressed. Just trying to see. Andre, I'm going to use you as a test case. Tell me if you are able to unmute.
I am, yes, it works.
Okay, all right, perfect. So colleagues, to make it easier, you can go ahead and put your hands up if you've got a question, and then we'll be able to allow you to speak from our side. If there's a question that you'd like to ask, please raise your hand. We'll pick it up on this side, and we will unmute your mic, and then you can ask the question directly. It's sometimes easier to voice your question than to type it on the chat box. This opportunity doesn't come too often that we allow you to speak in these webinars. Is it Ishmael?
Jared.
Okay, let me find you. Now that I've promised heaven and earth, let me, okay, you have been enabled. Please unmute and then you can ask your question.
Greetings, everyone. Thank you so much for a wonderful webinar. It's clear that we've delved into the concerns of the industry, both at a big level and at a junior level. I'd just like to ask, to what extent is the Mineral Council the intermediary between the industry and government? Because it's clear that there's a misalignment between what government's current policy is as to what the industry needs for it to grow. So I'd just like that question with respect to the Minerals Council being an intermediary, if at all.
Thanks for Jared. The Minerals Council as an advocacy body is pretty much a union of employers in the mining space. And our role is to represent the interest of the industry at all levels. And when it comes to government, not just the DMPR, but all of the other government departments, we are the voice of the industry, and we advocate for the industry. And whenever we engage with government, we always want to make sure that all of the policies that are in place, all of the regulations that are in place, the infrastructure that is in place does allow the industry to thrive. So in our engagements with government, that is our main focus. What is it that we need to, what stumbling blocks are there, and how do we remove them to ensure that the industry can continue to grow and to thrive? There's lots of challenges in the South African context. Our industry does have a legacy, so there's a number of things that we're working on. But some of the challenges, such as lack of electricity, we consume, at some point, we consume 30% of Eskom's production. So imagine, with load shedding. Hence, us as an industry working with government as part of the National Electricity Crisis Committee, NECOM, getting in there, working with government and Eskom to ensure that you keep the lights on. Because when those lights are off at your house, that affects our ability as an industry to operate. Likewise, with the logistics, we've been working with government to assist Transnet in making sure that they can get those rails are working, so that again we can get our product to market and so on. You would have seen in the news with the smelters in our negotiations around enabling tariffs. And again, for us it is important that the input costs are kept at a minimum, at least the increases. And as you know, electricity has gone up by some 900% over the last one. You'll help me here, 10 years or so. And that is not affordable by the industry that uses, again, 30% of Eskom's production. So our role really is to advocate for the industry, but to also work with government to ensure that we are in a position to do what we need to do as a sector, continue and maintain the jobs that we have, and in fact, grow the industry as well. Grant, do you want to add
Yeah, I
to that
just wanted
before
to-
I go to Dr.
Yeah.
Bristow?
I just wanted to add on, we, as Alex said, we respond to any major policy that comes out, and it's a formal response and it's research-based. And we always include the junior mining perspective on that. So whether it's environmental legislation, and we usually run a survey amongst our members to get an opinion on how that piece of legislation is going to impact on them. And through all the different areas, whether it's health and safety, environment, even economics. So we always include the junior sector in that.
Thanks, Grant. Dr. Bristow? You can unmute. We are still unmuted.
Okay, got it. Sorry, a bit slow. Just to get down to the basics, Alex and Grant, and I mean, these are sort of the fundamental questions. Can you give us an update on where we are with the cadastre system and when that will start showing signs of positivity? The second point, I'd be interested to hear how many juniors have effectively been enabled or supported through the Junior Mining Initiative, where there's supposedly funds available for small companies, and there's been a guideline about which commodities will be supported or which commodities junior miners can pursue. And then my last one, what's been done with the CGS to make information available in a sensible, practical way for small miners? One of the biggest problems in this country is access to information. Many small miners don't have readily access funds to go and search for stuff in the CGS. So those are my three questions. I'd appreciate your comments or answers.
Thanks, Dr. Bristow. I should have gotten somebody from the DMPR to answer those questions, because they all apply to the regulator. But be that as it may, from our engagements with government, as we know, the mining cadastre is being rolled out slowly. The initial province that was covered was the Western Cape, where there's a lot of wine farms and very little mining. But that was to ensure that the work that the department does is done properly. So you start with a smaller bite, so to speak, rather than go straight into the Northwest or Limpopo, where there are hundreds of mines that you would have to deal with. The process has been a lot slower than we would have desired, but we have been promised that the rollout will be speeded up. But again, it is not. It is outside of our control as the mining industry. The Department of Mineral and Petroleum Resources is solely running with the program together with their service providers. We are, as an industry, at the mercy of the department when it comes to that. But as far as we know, the process is ongoing. It is stop-start, so to speak, and it is very, very slow, very, very frustrating, frustrating to us as well. But we have been assured that the process is ongoing, and we will soon have a cadastre. We do not think that we will have a fully functional cadastre for the next 5 years. Looking at the pace of the rollout that we have observed thus far. So it is a bit of a challenge, and I think we were all excited when it was announced that we are finally getting off the blocks. But getting off the blocks has been at a very, very slow pace. That's the unfortunate one. I'm going to ask Grant to respond to the number of juniors that have been funded through the DMPR ITC fund. And again, we are not involved in the awards and or adjudication of those applications. And I'll also ask Grant to deal with the issue of information availability through the CGS, what the situation is in that regard. Grant?
Okay. Well, I'll try and answer, John. we are the outsiders, but we do interact closely. On the IDC fund, the latest information I've got when I last spoke to the manager running it was that 2 of their projects are showing promise, and further funding is being sought for those projects. The PIC, I still don't have information. I have requested, and I'm going to follow up, but I still don't have information. It's a very early stage in the fund, so hopefully we will get some information as we move along. The CGS, again, we're not inside the CGS. We do have bilateral meetings, but CEO to CEO meetings every 6 months. And the availability of information, I know they are working on it, but again, I'm not in a position to comment exactly.
Thanks,
Okay.
Grant. I'm sure that's not bringing you any joy, Dr. Bristow, but that's where we sit at present.
Yeah, Alex, I mean, I think it's a tragedy. I'm fortunate I live in the Western Cape. I know full well how this process is moving in the Western Cape. And you talk about slow 5 years, we should put a bet on that. And it's a tragedy because we have so many opportunities. And I've been fortunate in the last year to go to Angola and to Botswana, and it's chalk as to cheese. And my appeal is that every one of our geological organizations, whether it's the Chamber, GSSA, SAIMM, we really need to get together collectively and put pressure on the powers that be to get this process doing a lot better and moving a lot quicker. So that's just my comment. I just think unless we have a new paradigm and a new approach to how we deal with government, we're going backwards, and the job unemployment will just get worse. So that's my tuppence for the day. But thanks for the webinar.
Thanks, Dr. Bristow. Any other questions, colleagues? Cornelis? You can find the mute button and then come through. Cornelius, the floor is yours.
Yes, I've got it. Thank you, gentlemen. And it's a great webinar. I'm really coming from a logistical background to this new industry unknown to me. We are focusing on circularity and ESG. We're a specific focus on the majors' balance sheet with their liability as to the old mining dumps. So we are really started up with some pilot sites on the old mining dumps, but our focus is in manganese. We are really looking at how we can go about to introduce a toll treatment to artisanal miners and small miners, so that we can build a supply chain of manganese as a feeding stock to the battery markets, specifically in Europe. Our approach is that we're probably looking at 20 to 30 million rands of capital that needs to be injected into the development side of it, but we're unaware where one can really look for opportunities of funding. I'm very grateful to with the insights that Francois has given us on this matter, but we are looking forward to progress with our whole development. If you can give some feedback on that.
You stumped us.
Cornelis, we are looking at each other here, trying to see who can best answer you.
I know it's a tough one, but because getting funding, obviously, we've already utilized the 3 Fs in this game, and we've also sold a portion of the company's share in it. But we're really getting to the last level to really commercialize the whole project.
Yeah, it's a bit of a tricky one. Maybe let's take it offline, Cornelis, and see if we can direct you to a place where that can assist you, because we are really not in logistics. But obviously, all of our members have got one area of logistics or another that they deal with. But please get hold of Grant. His email is posted on the chat, and then we can try and see if we can assist you.
Alex, I just wanted to repoint you to it. My background is logistics, but the focus is really in stranded, abandoned mining assets and reworking and reprocessing that. Because there's a great opportunity for small miners and communities to get involvement and engage. And it will tick a lot of boxes on the major miners' checklist. I hope you understand where we're coming from here.
I think if you send me a note, please, and in some detail what you're looking for, and then we'll search and get back to you.
Okay, Grant, appreciate it. Many thanks, gentlemen. It is a great show.
Thank you. There is a question on the chat box about the number of listed junior miners on the JSE. At the last count, we were looking at about 11 or 12. Patricia was on the online earlier, but that's the number that we think is correct. 11 or 12, somewhere there. So it is not like Canada, where you're talking about more than 1,000 listed entities, or even Australia, where you're looking at some 700 to 900 companies that are listed on the stock exchange over there. So we are in need of more listings on the JSE, and the JSE has done quite a bit. So there's the unpacks as well, which allows for companies to also list. Yeah, and we work very closely with the JSE on a number of things, getting to understand the ins and outs of the JSE, the options that are available for junior miners as well. So if you need more assistance in getting to know about the JSE, you can come through us. We'll get you in contact with the likes of Patricia, Sam, and Maurice, the people that we work with on the JSE when it comes to junior mining.
Just adding on the JSE, look, as Alex said, we work very closely. They've got the project called Private Placements, which deals with the junior sector. And Sam Mokbaroko is the person who heads that up. So they are very, very keen on developing this junior sector. They also, I want to go back to a question there was on the chat about flow-through shares. They helped us about 7 years ago get going in the flow-through share area. They put us in contact with experts in the field, from banks, economists, and we developed a very, very comprehensive proposal to National Treasury. It wasn't just like a good idea. It was actually a practical toolkit on how National Treasury could implement flow-through shares. And we believed, and again, from the economic modeling, that would have a significant impact on getting exploration going in South Africa. You probably know or might not know, but Canada's success in exploration has been largely dependent on the flow-through share tax incentive model. We presented to National Treasury in 2020. We've had subsequent meetings, but unfortunately, we haven't got it across the line yet. One of the interesting aspects of the flow-through share concept is that exploration, one always thinks of exploration that, you get the prize once you find the deposit. But our modeling indicated that just by virtue of spending money on exploration, you get a positive impact on the fiscus because you're employing people, you're buying materials, etc., etc. Anyway, so far we have been successful, but we will continue to motivate for that.
Thanks, Grant. Hey, we are at 12:40, and I don't see any more hands, and I don't see any questions on the chat box. And I've been giving the role to thank everyone for attending. Without you, there is no webinar. But also to Camilla and her team at SIGN, Dina in particular, for pulling this together for us. It's for us, it's one of the things that we like to do for the simple reason that this is the future of mining. Junior mining and exploration, without those, there won't be major miners. So we really, really appreciate your attendance, and we hope that you'll engage with us as we go forward. And we are always ready to to deal with any of the challenges that you do face, although actually we will not give you money or anything like that. And we will not be doing matchmaking for you. But in terms of information that you require, please reach out to us, and we will ensure that we can assist. Where we can assist, we will assist. I'd like to thank Grant for pulling this together, but this would not have been possible also without the three presenters, starting with Bongani. Thanks, Bongani, for that great overview, and more importantly to Francois Janse van Rensburg for sharing some of the new things that he's come across in his studies in terms of this space. And it is very, very clear that this is not about this is not like getting a loan to buy a vehicle or to buy a house. There's a lot more that is required in the space that we are in. It is very, very important. Hence, us doing this research, and thanks to Mani for doing the research and for presenting some of the findings. Because again, without information that's up to date, we are unable to do our advocacy as the Minerals Council. So thanks to the presenters, and thanks to Grant, thanks to the SIGN team for pulling this together, and thanks to Bongani, and more importantly, thanks to you for attending. Please reach out to us. We'll be more than happy to continue engaging going forward. Your attendance is much appreciated, and we'll see you again at the next webinar as and when it comes up. Thank you very much.
Thanks, everyone. Bye-bye.
Thank you. Bye.
Okay.